Well, let's return now to the Bank of England's decision to hold the base rate of interest. We have a panel of guests to digest that decision. Michael Saunders is a former member of the Bank of England's Monetary Policy Committee. Sally Mitchell is also known as the Mortgage Mum and is a senior mortgage broker. And Sarah Pennells is a consumer finance specialist at Royal London. Thank you all so much for joining us. Michael, to you first of all, just looking at this decision, it has been held again. We're seeing the mood music coming from other places, including the Fed in America and the ECB, to maybe start lowering interest rates. Do you think that this is the start now of potentially a downward trajectory?
I think interest rates will be coming down eventually in the UK, but not quickly. And unlike the US Federal Reserve statement last night, there's no signal from the Bank of England that it expects to be cutting interest rates anytime soon. Indeed, their language is very much about keeping rates on hold at the current restrictive level for an extended period of time. So I think people here will have to wait really quite a little longer.
You are a member of the Monetary Policy Committee back in 2016 to 2022. What kind of things would they have been weighing up in the couple of days before they came to this decision?
Well, the economy overall is pretty flat. It's been flat for about a year and it's likely to remain flat in the next few quarters. Inflation, though coming down, is still well above the 2% target. And particularly importantly for the Bank of England, services inflation and pay growth are well above rates which are consistent with a sustained return to the 2% inflation target. So in order for them to think about cutting interest rates, they'd need to see inflation back down to or close to the 2% target and significantly lower rates of services inflation and pay growth.
OK, so those are the things that they're going to be weighing up. And let's bring in Sally now, the mortgage mum, senior mortgage broker. And Sally, of course, for most of us, the key elements for interest rates are savings, if we're lucky enough to have them, but more likely a mortgage. Yeah. The mortgage rate here, of course, it will look at this and then, well, basically explain to us, rather than me mangling my sentences into a huge tangle. What's the relationship between what the Bank of England has decided and the mortgage rates for all of us?
Well, it's good news. I mean, we have seen lenders starting to reduce their rates across the board. With this retention of the 5.25, it means that if you are on a tracker mortgage, which some people are, then you're not going to see an increase. If you're on the standard variable rate, you shouldn't see an increase. And bearing in mind, these customers can see, a jump every 6 weeks or so, if that's what the base rate dictates. The vast majority of people are on fixed rate mortgages, and the confidence, I think, is really important, not to underestimate the confidence that this decision gives lenders, and the fact that swap rates are continuing to come down. That gives the lenders the belief that it's okay to reduce their product rates, which is great news. It's not uncommon at the moment to find a mortgage rate, around 4.5, 4.6%. And bearing in mind that we were close to 6.5, 7 a couple of months ago, it's good news for mortgage customers. It's still high, but it's going in the right direction.
Do you think, how long do you think it's going to take before they fall back to the levels they were a couple of years ago? Or do you not think they are going to ever go back to those kind of levels?
I hate to do predictions because I don't have a crystal ball. But the consensus is that we won't see those COVID levels of rates, so sub 1%, 1.5%. I don't want to say in my lifetime, but I can't see them coming back. People believe, or experts tell me, that really if we can settle around 3.5, that will become the new normal, but they're not expecting that till 2025, 2026. So we've got to ride this out for quite a while longer. But again, it's confidence. We're seeing lenders reduce. This last few weeks, you'd think coming up to Christmas that the market would be sticky, it would be slow. It's not slowing down. I think people are waiting for this calmness to come, which this result will give them, this confidence again, to get on with it, to remortgage, to make a decision on that purchase that they've been thinking about or holding off from. So it's good news for the market. It really is.
Let's bring in now Sarah Pennells, consumer finance specialist, founder of Savvy Woman. Sarah, of course, we talked about mortgages there, but then there are those people that have savings. And of course, the banks seem to have been enormously reluctant to pass on interest rate increases to savers. Are they catching up, and might savers, even though this is a stick, might savers actually see interest rates going up?
Well, you're right that in the past, banks were taking their time to pass on interest rate rises, but that really has changed this year. And that's been a combination of some pressure from the government and also from the regulator, the Financial Conduct Authority. And I was checking rates this morning, and you can actually get close to the base rate. You can get over 5% on an easy access account, so where you don't have to give the bank any warning that you want to take the money out. And you, unlike previously, where you really had to lock your money away for sort of 3, 4, 5 years in order to get a good return, you're actually getting pretty much the same rate if you have an easy access account or one that is a fixed rate account for 1 year, as if you lock your money away. In actual fact, building on what others are saying, because the expectation is that interest rates will come down, there's no incentive to lock your money away for 4 or 5 years, because you'll get less than if you put it in an account where you can take the money out straight away. So I actually think that one of the reasons that a lot of savers don't switch is they think it's not worth it. And I do think it's important to get the message out that it actually is, especially if you've had your savings account for a long time, where you could be getting far less than 1%. But there's actually 5% or more out on the market. And at the Royal London, we've been doing a lot of research in the cost of living, and we're finding that even though interest rates haven't risen today, people are not necessarily sort of getting the best rates, and they are still very worried about their mortgages. And a lot of people are saying they are going overdrawn because of what's happened already with mortgage rate rises. About a third of people tell us they go overdrawn. And about 1 in 8 people who have a mortgage are telling us they've been borrowing on their credit cards, going overdrawn, or reducing their payments to pay for mortgage rate rises. So definitely still a lot of pressure on people who've got a mortgage, even though rates haven't gone up today.
OK, we're going to leave it there. Sarah Pennells, Sally Mitchell and Michael Saunders, thank you all very much for giving us your reaction to the Bank of England keeping interest rates as they were. Thank you.